Okay, today we will discuss insurance contract, which is explained by IFRS 4 with detail. So, insurance contracts. What is insurance contracts and what is insurer? What is insured person? Uh, who are the policy makers? And today's video, these all terms will be clear with their own numbers. Okay, first of all, uh, focus on this word insurance contracts. We know insurance, health insurance, life insurance, people often do for their families, for their cars, for their houses, for their businesses. uh, they issue from banks or from any insurance companies today era. A lot of insurance companies have been established, created for the reason, for the safety reasons. And contracts as the agreement and between the policyholder and the insured person. uh, IFRS for insurance contracts. And insurance the insurance policy is a contract, generally a standard form contract between the insurer and the policyholder. Who is insurer and who is a policyholder? Insurer is a person who is demanding money from you. You have to pay. A policyholder is an insured person. A policyholder will pay money as a premium, which determines the claims which the insurer is legally required to pay. Insurer is legally required to pay in exchange for the initial payment known as premium. As I said before, that the initial payment you do as an insured person is called premium. The insurer promised to pay for loss. The insurer promised to pay for loss caused by perils jeopardy covered under the policy language. One word is used here, perils, which is called jeopardy. Anything happened unusual, the insured person will pay. The insurer will pay. Insurer means the bank or the insured insurance company. Insurance contracts are designed to meet specific needs and thus have many features not found in many other types of contracts, since insurance policy are standard forms. There are so many features which you will easily find in insurance contracts, which you cannot find in any other contracts. So it is very flexible in elastic contracts and between the insured and the policy holder. Over here in this slide, the insurance policy is generally an integrated contract, meaning that it includes all forms associated with the agreement between the insured and the insurer. An insurance contract, you will find these two words more often again and again. In some cases, however, the supplementary writing, such as a letter sent after the final agreement, can make the insurance policy a non-integrated contract. One insurance textbook states that generally courts consider all prior negotiations or agreement, every contractual term, and the policy at the time of delivery, as well as those written after a policy provider's an endorsement. Insurance contracts with both parties consent are part of the written policy. The insurance contracts or agreements is a contract whereby the insurer promises to pay. Insurer promises to pay benefits to the insurer, the person who has paid amount for the life insurance, for the property, for the car insurance, or other insurance type to the company, to the insurance company, or to the bank. the bank or the insurance company will promise to pay benefits on that amount, on that principal amount which he has deposited in the insurance contract, or on their behalf of third party if certain defined event occurs subject to the fortuity principle. The event must be uncertain. The uncertainty can be either is when the event will happen, and in a life insurance policy, the time of the insured death is uncertain, or is if it will happen at all. In a fire insurance policy, whether or not a fire will occur at all. So this is the main point, that it is uncertain at all. In the United States, property and casualty insurer typically use similar or even identical language in their standard insurance policies, which are drafted by advisory organizations such as Insurance Service Office and American Association of Insurance Service. These are two organizations which issues insurance, and people invested, people do their insurance, life insurance and other insurance in these companies. This reduces the regulatory burden for insurer. Its policy forms must be approved by the state. It also allows consumer to more readily compare policies, albeit at the expense of the consumer choice. In addition, as policy forms are reviewed by courts, the interpretation becomes more predictable as courts elaborate upon the interpretation of the same clauses in the same policy forms rather than different policies from different insurers. Okay, so this is all about the insurance contracts. If you have any questions, so you can ask in a comment box, which will be helpful for me as well as for you. Thank you for watching. Thank you.